Hardy's WSB options Q&A. So without further ado, let's get into it.
No problem. So Hipsticks Keeper, T-Prince, just please, if anyone acts inappropriately or tries to bomb the talks, don't hesitate to use the remove from talk option.
That's what 10 for.
Alrighty. Let's see, GameStop. Alright, everybody, thank you all for trickling in. We'll be starting in about 2 minutes. Just trying to get my bearings with the current market open, see if there's any opportunities for me.
How many monitors and/or phones are you operating right now, Hardy?
You don't want to know the answer to that. Well, we'll go over the posted questions first. I'll be getting started in a minute, everyone. Just kindly post your question to the comments. The highest upvoted questions will be answered first.
Morning, everyone.
Good morning. GameStop touched almost 28 at open. It went over 28 at open, so 500,000 shares traded.
I'm loving that. All right. I think this is as many people as we're going to get, so let's get started. IOT asked, if they buy Twitter stock, what are the chances they can own part of Twitter's official stock privately? The short answer is they won't. So if you were to buy Twitter stock on the open market, keep in mind that shareholders of Twitter voted to accept Elon Musk's offer to buy shares at $54.20. So if in the event you're able to acquire Twitter stock on a public exchange, when the stock is delisted, you will receive $54.20 per share. There's not much you can do to avoid that. Long quarter 413 asking about Wish. Can you please elaborate? Okay. Gojo Sensei 2 is asking, they have 374 puts expiring October 28, purchased last week at $600 premium each. Okay. Do you think it's better to roll them out or sell them off today? You're usually better off selling and then reopening yourself. If you use the broker's roll feature, you're effectively paying them a larger spread than they would otherwise accept by doing the rolling yourself. Let's see. Basshead 420 asking, how do we think war escalation and a black swan event could affect the markets long term? On a long enough time scale, markets go up. So how would you define long term? Broadly speaking, a black swan event could have market impacts for 5 to 7 years. It's approximately how long the 2008 crash affected markets. A war escalation. A war escalation depends on how escalated the war gets. Wolfpack Rider asking, why isn't Tesla stock falling down? Because there are more buyers than sellers. Did Elon Musk acquire Twitter without selling any stock? Yes. They assumed that stock would sell off around 10%. Is there any reason why the stock's still holding the line? The simple answer is that there are more buyers than sellers. Keep in mind, Musk is not compelled to sell Twitter. There's a very good chance that in the course of acquiring Twitter, Musk effectively raised a separate acquisition fund, majority funded by his own family office, but also accepting investment from the likes of Susquehanna or who else would he?
He actually raised money from Andreessen Horowitz and Larry Ellis for
Oh,
this.
Larry Ellison too?
Yeah, they ended up putting in those two guys are specifically mentioned in a private raise of $7 billion. So I don't know exactly how much those two put in of that 7 billion, but they put in money.
But so the short answer then is that Musk did not put up the entire $44 billion cash. And that's how he's able to not sell more Tesla shares than maybe had been expected. Business unit asking, say I hold shares of a company and decide to buy puts on that. How does exercising those puts work? So whoever owns the contract that you choose to exercise would be compelled to buy those shares from you at the strike price. So generally speaking, if a put contract is in the money, you could hypothetically buy 100 shares off the market and then sell them for the strike price to that person who sold you the put contract for the strike price that is higher than the market price and realize your profit almost instantaneously. In the case of shares you already own, similar concept. Those shares, if you choose, can be sold or will be bought by the holder of the short put contract that you exercised. Answered that. Chaser with a bunch of numbers. When I have, let's say, November 18 puts or calls, do I wait the whole time frame or do I sell as soon as it hits the strike price? So the short answer is, if there's a better use for my capital or the money that I have, I'm very willing to close the current position and reallocate the money elsewhere. Oftentimes, the risk reward or the probability of the trade going against me at that point is higher than a brand new trade, and part of the reason why I'm able to have so many plays open at the same time, and how I'm able to track so many plays, and also the need for having so many plays in the first place. As for the time of day that I join in, when the price is right. So if something materially changes about the company, for example, some news alert, I have tools in place that'll automatically cancel trades associated with that ticker, because oftentimes I cannot outrun the speed of the NLP or machine reading algorithms developed by actual professionals. Slap My Nuke asking, why is GME about to be $700 today? Because stocks always go up. There's no real thesis for GME going to 700, but I do want to point out that if the short interest is truly that high, keep in mind the last time the short interest was that high was January 2021. Now, because of the nature, one theory for the short interest being this high is because Credit Suisse is effectively holding the bag. So if Credit Suisse is compelled to cover shorts, there's a possibility there won't be enough money to cover those shorts, which would effectively cap Moesis or MOAS. But because of the nature of what's going on, and because this has never really happened before, I hesitate to make those kind of predictions with any confidence. I know a lot of folks try to point out to Volkswagen and Porsche and that debacle, but that was a single entity announcing to the world that it had more shares than were expected, which caused the rest of the market to realize someone was naked out there. And eventually it was revealed some entity was holding the clothes and was forced to pay out for it. This is a little bit different, where you have a collection of individual investors who hold a known amount of shares, and then a separate group of market participants who are shorting shares and trying to borrow them using all manner of, I would say unethical, certainly not illegal, but definitely unethical tactics.
I like to send my greeting out there on to express my opinion.
If you're able to express it as a question, we're happy to answer.
Well, I just like to know more about this issue or this program, so I may learn to give my own thoughts.
Well, the purpose of this program is to help apes get more wrinkles. A lot of folks on Wall Street Bets have been resorting to posting memes, and while memes are always fun, I'm of the opinion that what made Wall Street Bets especially attractive in the early days were people posting their own due diligence and posting their own trade theses and having them audited or ridiculed or praised by otherwise unconnected random people on the internet. And so it helped harden those theses and make some of them especially profitable.
Mm. Very nice.
All right, thanks
Uh,
for asking your
uh,
question.
like a Reddit in Africa here, for me, Sierra Leone. So I just want the world to know how nice my country will be
Well, thank you
for
for
doing
sharing, Living.
for doing business like diamond, because this country we have gold.
Okay, moving on. What is a question I haven't answered yet? So someone is asking, does it ever make sense to try calculating IV or implied volatility yourself, or are the values from broker good enough? Generally speaking, the broker values are hard to trust because you don't know what assumptions they're making in their implied volatility model. So it doesn't hurt to use Black-Scholes to calculate what the implied volatility is for that specific options contract, and then after getting the implied volatility, deriving the other Greeks and seeing how they compare to the broker screens. Any instance where there's a large discrepancy, let's say more than 10%, is a good sign that there's an opportunity to be made or some form of information arbitrage. So Lemon here says they're looking on TD Ameritrade, XOM, Exxon options trade, November 4, 2022, $109 call. Oh, the opt-int. So opt-int, I think, is short for open interest. It basically means there are in this case, 1,622 contracts that have been opened and exist. So that implies there are 1,622 pairs of buyers and sellers of those contracts who have agreed to either buy or sell the shares at $109 a share for some premium price. My Miller Lite, how do you determine strike price? Could you please elaborate or clarify? I don't quite understand your question. Gojo Sensei asking, what is the best time to buy puts when you think the price is going to go down? It depends largely on the chance that you expect, the circumstances under which you expect those puts to make money. So theta is the time decay component of an options price. So if you were to buy an option but the underlying price goes nowhere, your theta burn, or the cost of theta, will reduce the value of your option and effectively eat away at your position day over day. Delta is the change in the options price for every $1 move in the underlying option price. And so in order to profit off of delta, the underlying stock price needs to move in the direction of your options contract faster than the market expected it to move. And the other, slightly less important but still useful, Vega, is the sensitivity of an options price to implied volatility. Generally speaking, the higher the Vega, the more sensitive the option is to the implied volatility, which could also be described as the risk premium that a seller of an options contract wants to receive in exchange for the right to sell the option or to sell the shares or buy the shares from the buyer of that contract. So if you think the price is going to drop quickly, you want to buy as close to the event as possible. There are instances, however, where an event can reduce the implied volatility because the uncertainty from that implied volatility goes away. And so you need to make sure that the price movement exceeds the potential decrease in implied volatility. So think of it as IV change multiplied by Vega needs to be smaller than underlying change multiplied by delta. Dreamville, more monitors does not automatically mean more money, but it does mean I have a huge E-peen. And I could probably, well, I'm sure our battle stations would love this this setup, except my cable management is atrocious. All right. Someone's asking to go over GIS in terms of delta neutral, gamma max. Sure, let's have a look. So GIS in the past reacted well to gamma max in that whenever the price went to gamma max, it would automatically fall following, and often very quickly. So the thesis being then the current open interest of options and the hypothetical portfolio that produces has a portfolio gamma that's highest at some price level. And whenever the underlying price reached that price level, it would reverse very quickly and go away from gamma max. So in the case of GIS, I don't really see much of a defined pattern. The last trade that this pattern worked for appears to have happened around August 19. More recently, whenever the price touches or crosses gamma max, there isn't much of a predictable reaction. So at least for GIS, I would probably stand aside. I did notice that there's a huge gamma max spike, relatively speaking. So it's possible that could, how do I put this? That could represent a thinning of open interest, which in turn increases the uncertainty of the gamma max value or the hypothetical portfolio's gamma. Okay, big lots. So Leap and Leopard asking, how do options, puts, and calls ratio affect a stock's price? So assuming a perfectly efficient market where there is no information asymmetry, in other words, there's no information advantage, the expectation is that a market maker from whom you buy an options contract wants to hedge that options contract so that their exposure is not to the movement of the underlying stock. And the closer you get to the strike price of that options contract, the more shares that market maker needs to buy in order to maintain the hedge. Now, in the case of a gamma squeeze, if there's a lot of at the money or near out the money options contracts that are open, if the underlying price moves above the strike price, the hedging obligation by those who are short that options contract means they will be forced to buy more shares to maintain their hedge. But in the course of buying those shares, it also raises the price, which now crosses another strike price, which means more shares have to be bought in order to maintain the hedge, and so on. Now, I want to acknowledge this is a very simplistic explanation of how market making in the options markets work. There are other tools available to market makers in order to maintain a delta neutral stance or a slightly biased delta stance. So a high open interest in at the money or near the money does not automatically mean short squeeze. It needs to be a high open interest combined with some unexpected buying catalyst, which forces the price up, which forces the involuntary additional hedging that causes a snowball effect of sorts. Pleasant Anomaly asking, if they want to play earnings, when would be the best time to buy options? So if your intent is to profit from the overnight or aftermarket gap in the price, you want to buy the options as close as possible to the earnings announcement as you can. And you also want to buy the options that expire as close as possible after the earnings announcement. That way you minimize the impact of theta and maximize the impact of delta. However, you should beware the current implied volatility and what the implied volatility was prior to the run up to earnings, so you can get a sense of how much IV crush there is and discount your delta gain from the Vega loss. As for the kind of strategies that I usually go for, I generally keep it simple. I'm either long options or short, or if I'm short options, I'll do some sort of cash secured puts or covered calls. Very rarely do I do spreads or multi-legged strategies, mainly because as an individual retail investor, I don't have access to the kind of liquidity that institutions have, and so there is increased risk entering and exiting a trade.
Hey guys, are we talking about plays today or?
This is strictly options Q&A.
Oh, okay. Sorry, I thought we were like sharing stuff.
Naju, what is my secret for remaining so calm and collected? Bruh, I've seen shit. Very few things faze me nowadays, especially in the markets.
There was someone last night, Hardy, on one of my chats talking about how they get very emotional trading options. And I said the last time I got emotional trading options, Obama was president.
There you go. Maleficent Place. Do we all speak to crypto options? Not specifically. At least for now, this is more about equity options in the US markets. That said, I am excited for the prospect of crypto options, especially because settlement is automatic. So hypothetically, my fees and commissions are much lower than I would pay a broker. And in theory, so would my spreads. Although that depends, how do I put this? There is much less artificial price discovery going on in a hypothetical crypto options market. So someone's asking the rough number of monthly money I spend on subscriptions and so on for data sources. So I'm spending for my overall infrastructure on the order of like $5,000 to $6,000 a month. The bulk of it is actually in compute services. So think cloud compute from the likes of GCP or AWS. The data component is maybe $1,500 a month for options data, for certain API news feeds, that sort of stuff.
Hey, Hardy, I just wanted to thank you for allowing us to use that Gamma Delta one on your website. Appreciate that.
You're welcome.
Hey Hardy, I have a play that I was wondering if I could get your advice on it.
Sure. Let's hear it.
So I bought on Tuesday. I bought call options on ticker GWW Granger, I think it's called. It's an industrial company. They reported today earnings. They exceeded EPS by 17%. I bought the contract at around $7. It's around 15 right now. Expiring on November 15th or November 18th. And my question is, I've heard that options as they get closer to expiration price, they tend to decrease in price. Or like, when do you think would be the best time to sell?
So what was the strike and expiration again?
The strike price was 570 for November 18th. The stock price is 561 right now. I bought the contract at 730. It's at 1920 at this moment, or the last price was 1920 at this.
You bought puts?
Calls.
So I'm looking at Granger GWW November 18 570 calls. I'm showing the last traded price is $10.
For me, it shows. I'm using Fidelity. What do you use?
Interactive Brokers.
Which one's more up to date?
My $10 sale price happened as of 9:56:42. So it looks like, because there are only 15 contracts traded, that $15 valuation, or that $19 valuation I think you had, was because of a very thinly traded market. Now, I don't know how many contracts you have, but broadly speaking, in my trading, as part of my risk management and money management, I try to limit to exit half of the position on a double, so that I get my principal back, and then I'll either ladder out. So the next quarter would be at like 200%. Another quarter at 300%, I'd be out of the trade, or I'd look to see if there's a better what's the term, use of my capital, at which point I would exit the trade in its entirety, because the downside risk is greater than I'm willing to accept relative to the upside reward.
Got it. And do you have any limits on, say, like open interest or volume? Like, do you look for at least a minimum in case of like you
So I
wouldn't be
try to
aggressive?
be less than 5% of open interest and 20% of daily volume,
Got it. Thank you.
because above those levels, it's not hard to move the market. Viking Trade asking if Interactive Brokers is worthwhile. I say yes, but I also want to point out they are not my only broker. I do also use two other brokers, JP Morgan Prime Services and Fidelity. Interactive Brokers I do most of my degenerate trading on. JP Morgan I have my more boomer plays, and Fidelity holds my retirement accounts. And I very intentionally keep money across multiple brokers to avoid any suspicion of commingling funds, which is very much a no-no. Lucked out, yes. If Twitter is trading below 54.20 and you're able to buy shares below that 54.20, you theoretically can arbitrage your way to profit. Does Masterify? I subscribe mostly to quantitative theory, but that's only because I look for lack of a better term, pricing imperfections. Markets are otherwise quite efficient, and I don't have the patience for deep value plays. Long Quarter is asking if Wish is a good buy. Why do you think it's a good buy? Someone's asking if I like Desktop Metal, ticker DM, long term. Let's see. DM. I do not. I don't see any plays in the last 2 years that I would have taken on DM, mainly because it doesn't react well or predictably to delta neutral or gamma max, in my opinion.
Hardy, quick question. So, seemed to be in the morning talk that your thesis was that Apple will snap back to reality eventually with the other big tech. Being that it's up 5% today, is today a day you would be looking to enter buying puts or in another way shorting them?
We'll see. They basically are hovering right at delta neutral. So now that it's post earnings and IV is as low as it's going to get, I might, if I were to enter today on Apple, I'd probably do a straddle or strangle. Basically, we're at the point where the uncertainty is at its lowest, And if the implied volatility for a 6-month straddle or strangle is acceptably high, or maybe you can go down to like 4 months, so you can take advantage of IV expansion. You stand to have a higher probability of earning tendies. Lavishness Key is asking what Oxy options are good on the call side, given earnings should be exceptional. All employees just got a 5% bonus because business is so good. Earnings on November 8. So Oxy, let's see. Oxy is trending toward Gamma Max, so if you think earnings will be exceptionally good, let's see. Oxy, looking at the options chain. So November 8 is earnings for Oxy, right? So the next expiration after would be November 14, and the implied volatility is at the highest it's been in a year, it looks like. So because of that, if you think the implied volatility will go even higher, then go ahead and buy a straddle or strangle today. Sell that straddle strangle before earnings so that you capture the change in IV. And then at earnings itself, assuming you want to play earnings directly, you can look at the cost of a straddle or strangle for the November 11 expiration on November 8. I assume they're doing it after market close, and decide if the cost of the straddle, which is currently about, what is that, $5, $6, which means the price needs to move $5 or $6 away from the current price in order for your straddle to break even. If you think the price will move farther than that, then go ahead and either buy the straddle or buy the direction you think the stock will go. I realize it's long-winded, but because some of this will happen in the future, I don't know what the price will be then. So just trying to leave you a framework to make that decision. Chaz asking if I have any thoughts on the Ortex GME borrowed shares data from yesterday. Short sold share data is always self-reported, so I don't really give it much credence. I use it more as a way to confirm other theses. Although I am, that said, in the event of Moasis or MOAS, if I hit my number, then you'll never hear from me again. Malhar asking where I expect SPY to close today. I expect it to close at 4 p.m. I have no idea where the price is going, and very often I try not to predict the price. I instead react to it. At least that's one aspect of my trading. I do want to point out, however, SPY did bounce off of delta neutral, so there's a good chance that it could go up or it could go back down.
SPY go down, boom.
So let's see. Ludite's asking, following a bit on the Apple talk from earlier, higher metrics compared to their peers. Is it worth looking at $100 to $125 puts for a couple quarters out on Apple with the belief that it too should correct down? We sort of discussed this earlier, but at this point, I'd probably, like, if I had to invest money in Apple options, I'd probably look at a 4 to 6 month strangle or straddle. The simple answer is I don't know if any retard strength is left in buying Apple, because Apple outperformed their peers among FANG. It could potentially be a flight to safety, which would make a reasonable bull case. But, economy's going to shit, which would make a very reasonable bear case. And I don't know which one's going to win.
Thank you, Hardy, for answering all these questions. I do appreciate it.
So, Kremshin asking, Amazon is now down to pre-COVID value. Is it undervalued due to a single earnings report, or is there more to it? Part of the problem, I suspect, is because Amazon's expenses have gone up. Net of inflation, net of suppliers, net of labor, net of benefits that need to be paid out, net of their churn. Because I think there was some internal report saying Amazon spends $8 billion a year on rehiring or on laying off, or what's the term? Churning through their workforce, and that's just the measurable amount. Now, layoffs could be possible, or transition to seasonal workers and such. I have noticed anecdotally that Meta, as a quick example, laid off a bunch of secondary engineers. Think data engineers, front-end engineers, data science types, analytics engineers, etc. According to LinkedIn, anyway. And they've been reaching out, or recruiters have been reaching out to hire data engineering contractors. I imagine Amazon is doing something similar in that they're replacing relatively expensive full-time employees with contracted workers. But that doesn't automatically mean bearish on Amazon. They could just as easily outperform their peers into this Black Friday storm. If I had to make a bull case for the rest of the year and first quarter, what would that hypothesis look like? Santa Claus rally plus election interference. And like broadly around those themes. But that's if I had to be bullish. Okay.
I was born a bear.
So, Xenophobia asking big lots the next meme stop? I don't know. Could be, could not be. Either way, there are strategies to make money from what mathematically would be irrational increases in the stock price.
What's up, edition?
So Freddie asking right now, they have Schwab level 1 looking to expand into spreads. Generally speaking, the reason why spreads require a higher level option is because of collateral requirements. So Schwab wants to know that you have the collateral and the willingness to put up that collateral in the event your spread goes tits up.
Could you set that spread yourself by just making the play without claiming the strategy and kind of circumvent that?
In theory, yes. In practice, they'll catch you.
10-4.
Elon needs to report if he sold more Tesla, I believe within 30 days of actually doing so. So theoretically, we have until Thanksgiving for Elon to submit that report to SEC. Will all Twitter options be closed before distribution of funds to shareholders? I would imagine yes. It's to your advantage to exercise any in-the-money options so that you can receive the payout as a shareholder. Options holders don't get jack. Rick asking, how much do people make playing the stock market? Just quit their job a couple of months ago, looking for ways to make extra money. Stock market isn't gonna be the way to do it, especially if you depend on this for like day-to-day income. I'm of the opinion discretionary trading like this is reserved for excess money. So like if you have your basics taken care of, this is the kind of way you can accelerate your earnings instead of trading time for money.
Well, that's it. I quit. Dang it.
Someone's asking, now that Twitter is delisted, how long will it take for brokerages to credit the money and how are the tax implications? That's a question for your broker and a licensed tax expert. I don't know your specific situation from a tax perspective. Someone's asking, are there advantages or disadvantages to making option plays on ETFs as opposed to individual stocks? The main advantage, I would imagine, is liquidity. So you're more likely to find a buyer or seller for your trade. The main disadvantage, of course, is ETFs have good and shit companies in the mix. So you theoretically could gain an advantage by buying the good companies and selling the shit companies. That's part of my problem with ETF investing in general. A lot of people just blindly throw money into ETFs, and that in turn causes irrational buying or selling, irrational buying, or buying at irrational prices. So, generally speaking, European style options contracts, Maleficent's brother asking about how options in Germany work. I don't know specifically, but broadly speaking, European options contracts let you exercise the option at maturity or at the expiration date, and only at the expiration date. And so the pricing is a little bit different versus American style options, where you can exercise at any time between today and the expiration date. Shepard is asking if I'll be keeping these casual like the old profile talks or going to keep it more Wall Street bets. As you may recall, Shepard, is the old talks, or at least when I originally started doing profile hosted talks, were much more Q&A focused. We'll see how this audience settles over time and how the engagement metrics look compared to other talks hosted not just on Wall Street Bets but on Reddit, and we'll figure out a decision from there. We just decided to do it today instead of next week, so that we can see the participation numbers when they come out on Monday.
Hardy, I have a question for you.
What's up?
How do you use IV when you're trying to determine your straddle or your strangle when there was an increase, say in Apple?
I look at the IV relative to the past. So yeah, one of the data sources I pay for is historical implied volatility or realized volatility, and from that, I'm able to see during the last earnings how much IV changed, right? So by knowing how much IV changed both in the run up and then in the subsequent crush following earnings, I'm able to I'm able to figure out or estimate the expected implied volatility movement for this next earnings. Incidentally, that's one of the other trading strategies I do. I buy straddles or strangles in the run up to earnings in situations where the Vega expansion or the IV expansion is faster than theta decay. And there are a couple of instances where that exists, but because of its mathematical nature, it's kind of hard to like post plays for everyone else to hop in on.
It's going to take me a long time to learn that, but I want to.
So Practical Fisk asking, where do I get short interest from? Normally just use Yahoo Finance, says GME about 20% of float. I don't trust any short interest number just because shorts are self-reported. So I use them directionally, and I get them wherever I see it posted on Reddit. Because if enough other market participants agree with that short interest number, whether or not it's true, they will buy or sell GameStop to reflect their worldview. And that's where I make my money.
Hey everyone, let's just throw up the Doge for Hardy for his hard work answering all these questions.
Thank you for sharing, Aliot. Robin Food asking, do I close my long options at a certain DTE if they don't play out, or let them expire? Broadly speaking, I'll usually let them expire if I don't find a better use for whatever capital is left. Because of the liquidity in certain options contracts that I play, I cannot trust a stop loss to catch me if the price falls. And so I size my positions that I can afford them to go to zero without wiping me out. Okay, Spare Bumblebee has a bit of a novel here. So mega caps have been predicting slower growth and lower margins. In my opinion, will these be seen by the Fed as an indicator that the interest rate hikes are starting to have an effect they want? No. The Fed has explicitly stated that they want to see unemployment increase, which means we need to see a lot more layoffs in the news before the Fed starts to taper the rate hikes. And with Thanksgiving and Christmas approaching, I expect the volume of layoff news to increase dramatically because no one wants to fire somebody over Thanksgiving or Christmas. That's too bad a look. As for the rate hike that I'm anticipating, 75 basis points, but we'll see like what happens over the weekend. Heisenbo asking, what about IV? They can go down, but you can lose money. I'm not sure the context of your question. Can you please elaborate? Luddites asking, people sometimes buy deep in the money calls as a way to essentially own shares at a discounted price. Why would someone sell those calls? Oftentimes they're trying to get out of a share position, but they're only willing to do it if they're exercised. So in my own trading, as a quick example, when GameStop was like $35 a share, I'd buy 100 shares and then sell like a $20 call against those 100 shares. So as even if I expect to get exercise, and in doing so, I effectively receive $38, $39 a share for my $35 a share acquisition, without the price going to $38, $39 a share. Hunk and Dry is saying they've Twitter puts that expired today, but trading is suspended. What will happen to the puts that you can't sell? Sorry, bro. You get to write them off.
Yeah, so much for the scratch-off tickets. They went to zero, like most of them.
IOT asking, how do I calculate the value of the options before market opens up? I use a binomial options pricing model to basically figure out where the price may go. Think of it like a series of simulations. And then based on those simulations, it'll create some sort of spread of expected value. And then I pick a price in that expected value that represents, let's say, a 70% chance of happening. Big Bang Boom Wolf Moon asking if there will be a transcript. Not officially, but you're welcome to download the recording when it's made available afterward and submit it to Otter AI or maybe Google Cloud or Amazon's speech-to-text engine. Plenty of options there. 13 Ghost asking, explaining straddling calls or puts. So a straddle basically means you buy a call and a put at the same strike price for the same expiration. The straddle pays off well when the price moves beyond the break-even point for the straddle in either direction, or the price has to move very far in one direction. A strangle is just a wider straddle. So instead of the same strikes, you have a call and a call at a high strike, a put at a low strike, and you expect the price to move outside that range. Pleasant Anomaly. What strategy is my go-to? I sell a lot of options. So I do a lot of like Theta Gang type strategies. And then the profits I gain from Theta I use in some occasional degenerate plays or in my discretionary plays that I post to WallStreetBets. Boiler needs stock. What's my website? Options.hardyrection.com. I'll put the link in the comments.
Mimic the spelling of his name on here for that one.
Yeah, be careful how you spell my name. Someone decided to make a porn website with a different spelling. Luddites Unite asking, what's the best resource to learn more about the Greeks? Options, Futures, and Other Derivatives by John C. Hall, 7th edition or later. What is the name of this music? Cool Jazz Loop. So
Every time. Someone asks every single time.
I don't mind. Someone's asking, talking about the Greeks in more detail. Okay, so a very brief summary. Delta is the sensitivity of the options contract to the underlying price's movement. So for every dollar move in GameStop, a delta of 40 means an option would go up 40 cents for that same dollar move. Gamma is the derivative of delta. So keep in mind, delta is not linear or flat. It changes relative to the distance to the strike price. So gamma is the change in delta the closer or farther away you would get to the strike price. Vega is the sensitivity or the jiggle factor that affects the options value to relative to implied volatility. Now, implied volatility is sort of a red herring because no one really knows how to calculate implied volatility. You have to get an options price, run it backwards through something like the Black-Scholes model or the Black-Scholes-Merton model to come up with an implied volatility number. And because that's so computationally expensive, oftentimes you'll find institutional trading desks are just looking at the market and then backwards calculating the implied volatility from the market price to calculate the market implied volatility. And to be fair, I'm doing the same thing. So effectively, everyone is looking at everyone else's test papers. And then theta is the time value associated with an option. Theta only ever decreases. The only time a theta increases is when the option is newly created. And think of it as the rent you pay for holding a long position in that options contract. So you need to make sure the money you earn from whatever your thesis is outpaces theta. Someone's asking an appropriate time to roll options and the benefit of rolling. There is no appropriate time to roll options. You're better off selling and rebuying on your own. And the benefit of rolling ostensibly is convenience, but you pay for that convenience. Bablu asking about my boomer plays. I sell right now cash secured puts against GameStop. I'm selling covered calls against SQQQ and realizing like a 5% weekly return on those. Yeah, there's your couple. Bad boy already asking about a short on American Airlines. I mean, if you want to, go for it. It depends entirely on your thesis.
I have a quick question for you.
What's up?
Would you be able to put the name of that options book in the comments or send it to me by chance?
It's in the comments. I forget who posted it, but it's definitely there.
All right, thanks. Appreciate it.
I do want to point out also that American Airlines has not been anywhere near delta neutral, so I'm hesitant to put a play on it. It's possible it could go up or it could go down. Let's see. Someone's saying they loaded up on AMD 61 puts, November 18 strike. The fuck? I think they meant $61 strike, November 18 puts. Due to the inventory glut Intel, Amazon missing revenue, plus rate hike earnings November 1. My thoughts are it could go down or it could go up. Someone asking if Apple sees 185 to 215 in the next 12 months. Yes or no? Maybe. So, buy a strangle or straddle. What type of indicators when people buy deep in the money puts, bullish or bearish? Neither. There are bullish and bearish reasons for having deep in the money puts. Does the Ortex news change anything with the GME Jan 23 237.50 calls? No. The thesis behind those calls is the Vega relative to Delta is strongest. So the Vega Delta ratio is much higher than any other options contract for GameStop. And the reason why that matters is when the price shoots up for some unexplained reason, the implied volatility increases, and with that, the value of the option relative because of the Vega. So I'm able to have a Vega play strictly on, well, as much as possible, minimize the effect of delta, gamma, and theta, and just play the swing in implied volatility, profit from Vega. Practical fix. Do I avoid small cap stocks altogether due to low volume? Not really. If they have a strong options market, let's say more than 20,000 contracts in open interest, I'll at least look at them. So someone's asking if they buy an in-the-money call and the price and volatility go up, is that a volatility play? No, not necessarily, because price also went up. What type of play is that, and what Greek exactly are you playing off? It's not any individual Greek, it's some combination, but they're not all equal strength. So if price went up and volatility went up, you're benefiting from both delta and Vega. Someone's asking how to make the red line green. Choke it blue.
That's the kind of info we're here for.
I think we'll keep going till around 11 o'clock and then call it a day. Where are the next batch of unanswered questions? Someone's asking, what non-statistical arbitrage or mean reversion plays do I like? Or what am I excited about long term? So pairs trades are nice. Anything that mean reverts away from gamma max or delta neutral are favorite plays. Non-statistical arbitrage or mean reversion plays. I mean, every so often I'll post a degenerate play about around some sort of news event, like Fed funds rate or earnings, but they certainly don't make up any substantial amount of my portfolio. And what I'm excited about more long term, major crash, because then I can convert all this cash and collateral that I have into deep value plays. Independent Lettuce asking if I have a sell limit order placed before market opens and the price opens higher than my limit price, will my broker give me higher market price or lower limit order price? That depends on whether or not your broker is participating in a payment for order flow and if your order truly was routed to a market. If it was routed to a market, it would be filled at the market price. Because think of a limit order doesn't guarantee you'll be filled at that price. Think of a limit order as a trigger. And by the time the price hits that trigger, or the trade, a most recently placed trade hits that trigger, it converts to a market order. Now, there are more complicated like order types across different exchanges, but I think that's beyond the scope of this conversation because odds are you're never going to have that kind of direct connection to markets. Someone is expecting the market to go downtown next 4 months and then stabilize. Agree or disagree? Well, I mean, it could go down or it could go up. Someone's running the wheel on a cash secured put. What is my thesis on when to roll position? I don't. So if the premium loss for my cash secured put approaches 100%, that is to say, I effectively have to pay double my premium earned to get it back, I'll exit the cash secured put and redeploy the capital elsewhere. I avoid rolling as much as possible. Synapse is asking the difference between gamma max and delta neutral. So according to the analysis on my website, I'm of the opinion I can treat each individual stock ticker as an options portfolio based off of the options open interest. And from that options portfolio, I can then calculate portfolio level Greeks and implied volatility and such. And from that portfolio Greek and implied volatility, I can then calculate the price at which the gamma is its highest and at which delta, the overall portfolio delta, is 0. So for stocks that have substantial institutional participation in their options markets, this seems to be a very strong indicator of where the actual money is. Forget smart or dumb, just actual money. And I use the reaction off of those price levels to place a lot of my own trades. Someone's asking, is if the option open interest reported in Yahoo a reliable number? I don't think so. And how much is it delayed? It's usually the previous closes option open interest or number of contracts out. Someone's asking my win-loss percentage. If you're doing straight like number of securities or trades, I'm probably at 65 to 70%, plus or minus maybe 5 points, somewhere in that range. Someone's asking if the meta crash is done or will Zuck find a new way to surprise us. I don't know. I think part of it will depend on how many Oculus Pros are sold in the holiday season, which I'm guessing is not many. So we could probably make Zuck an honorary mod here because he lost $100 billion over a year in personal wealth.
We should start a GoFundMe for him and the Amazon guy, Bezos.
Yeah, fuck that. Someone's saying a ticker of interest was Guild and it's only gone up since the morning. Depending on how quickly it went up, and like if there's any news or catalyst that caused it to go up, I would still be bearish on it, but I would also look at the other plays to see if there's a better opportunity. I'm not married to the Guild play, if that makes sense. Someone asking what are the factors to take into consideration for starting the stock market, options, etc., and advice for someone with no prior experience, how things work in the field, how to get started. I'm of the opinion, if you really want to make any meaningful money